I am Paris Jordan. I head up responsible investing at Charles Stanley, and I'll be your moderator today. If we just go down and introduce each of them, starting with Dan, who's got the microphone at the end. If you just introduce yourself briefly.
Hi everyone, hope you're enjoying your lunch. My name's Dan Babington. I'm the Sustainable Portfolio Manager at TAM Asset Management.
Hey everyone, I'm Jade Coysh from Momentum Global Investment Management. I'm a responsible investment specialist and portfolio manager. Thanks.
Afternoon everyone, I'm Ben Palmer and I'm the lead portfolio manager on the LGT Sustainable Model Portfolio range.
Hello everybody, I'm Will Slater, Business Development Manager at King & Shaxon.
Excellent, brilliant. So what we're going to do, we're going to talk around 3 topics kind of today, all of which related to kind of our responses to recent developments. Happy to take questions at any time, so I'll come to the audience and see if you want to ask anything throughout. But I mean, the broad question and where we're going to start is we have seen a huge amount of recent developments from SDR, extended SDR, and a variety of different interim kind of updates from the FCA. So kicking off just with the panel, you know, what do you think about some of the developments coming out related to SDR, particularly the recent developments? Starting with, Ben, you've got the microphone, go for it.
In the hot seat here. So yeah, I mean, conscious don't really want to go over too much old ground from what we've already heard, but I think you know, your point there, Paris, to Sasha at the end about how this is implemented in a portfolio context, I think is obviously what really drives a lot of our work and our thinking, and the levels of complexity that we believe are introduced as soon as you go into a model of funds or more of that discretionary management. So we've been very interested in terms of the updates on the SDR implementation for portfolio management services. I think we would have liked to seen a little bit more guidance within that rather than a hold fire. Well, not hold fire, I mean, importantly, we're all doing the work in the background, but we've given you an extension until you see the policy statement, but also we'd like to see maybe an indication of when the actual implementation timeline would be on the back of that. Because what is been a real challenge and really builds off your question, Paris, is that there's a bit of a waterfall effect here. You know, we're building our portfolios predominantly out of the funds, and our initial expectation was that this part of the process would be the easier part. So as we stood here at this date, we'd have pretty good visibility on the shape of the market, how that could be interpreted into our multi-asset you know, range of risk-adjusted portfolios, and I think we're still some way off of that. So whilst we're doing a lot of internal work, there's a big piece of the puzzle that's still missing in our opinion.
So I think for us, we're sort of plodding through, trying to work it out and plan before some of the guidance is officially published, but it's a little bit difficult because you don't want to do too much work and then basically there's a change. So we're trying to have as many sort of preparation meetings and things in anticipation of what's coming out, but the difficulty is that the goalpost keeps moving, and that is hard. But for me, I think from a fund selection perspective, you know, we're seeing some fund managers actually removing sustainability from their fund name, and some of these funds are really strong on sustainability, and the concern is that causes a bit of confusion, particularly for people that don't have the in-depth knowledge of those portfolios, you know, for retail investors. So, you know, this is predominantly for retail investors to improve their understanding. So, you know, that's a bit of a mixed message for me, and I have a bit of a concern there. But in terms of an extended SDR, I think we're sort of waiting and seeing at the moment.
Yeah, it sounds, from both of you, sounds like everything's a bit blurry. We're not quite so sure. Dan, are you echoing the same things? You know, as a smaller kind of wealth manager, what are you seeing?
Yeah, the overarching feeling at the moment is probably one of concern. When the initial regime came out, specified about funds, I was really optimistic. The non-hierarchical approach, talking about improvers, focus, impact, mixed goals, all on an even bracket. And I think that really encourages diversification of thought, and I think it can mobilize much more assets because clients have different goals, and you need to have client financial goals and their sustainable goals, and it's different for everyone. At the moment, speaking to fund managers, it's obviously taking longer than we would all expect, we all hoped, in terms of people getting labels. It's good to hear that now we're up to 10, and I'm hoping now that it's been kicked out 6 months to Q2, that we start to really get those labels coming into Q2, and we can really start to plan as portfolio managers. At the moment, as a sort of smaller, mid-sized DFM, there's probably a little bit of internal concern about the resource it's going to take to align to a label. We've been doing this for 10 years. It's something we take very seriously, but we're at a point where clients have started, actually, as you've seen in terms of flows, to maybe move away from sustainability. And we've been asked to invest probably quite a lot of money into alignment with new regulation and trying to formulate new ideas at a time where people have started to move away from it. So it's a huge leap of faith for DFMs to double down. And it's quite sad to see some DFMs who have established sustainability MPSs starting to look at closing them or rebranding them or alternative avenues. And that's not in the spirit of trying to mobilize capital in a positive way, which is why we're all here today.
Yeah, thank you. For us, the delay with what we've seen, and we've heard about this today, has not come as a surprise. This is a very complicated area, and I spend most of my time dealing on a day-to-day basis with financial planners, and I hope there's a few here in the audience at the moment. And there's a lot of confusion out there in the market. There's a lot of terminology used, a lot of different terminology used. There's many funds out there with many different names. And I think adding a layer of clarity is definitely what's needed in the industry today. It's far too confusing out there. It's confusing with your clients, and I think it puts off a lot of conversations around, call it ethical value, impact investing, and I've just used a few terms there as well. It puts off conversations with you and your clients regarding this area. And I think having clarity around that, especially with the labelling system that's being introduced, is a fantastic thing. It will help give clients and advisors more resource and information about what each of the funds do, whether they're labelled or not, and to build up a portfolio, and a client can make a proper informed choice by having more information. So having a delay, having this pushed back is not a surprise for us, but we think that's a very, very good thing, because we need to get this right, and we need to help you out there actually seeing clients and having these conversations. Thanks, Boris.
Thank you very much. So to summarise, it seems a bit blurry. We're all kind of in support of it in terms of making it more clear, and there's definitely a wait and see element. But given, if we push off the extended SDR piece at the moment and we focus on what has been rolled out and the 10 funds, for each of your firms, have you considered adapting your research processes to cater for labels, or is it something that's a nice to have and not something that's really affecting that process? Or was it something that you were going to have in your process, but because of the delays, because of the trouble that we've actually seen happen, it's not actually worth your time to consider a label anymore? Anyone take that? Yeah.
Yeah, I'll take that very quickly. The labelling hasn't affected our process at King & Shaxon whatsoever. For us, it's all about looking at each and every individual company that the funds invest in and going really down to that level of detail. Because at the end of the day, it's what the clients want. There will be some clients who want exclusion of certain industries and certain sectors. There'll be some clients that are looking for impact and sustainable goals, and it's about blending all of this with long-term clients and newer clients that are coming to us as well. So the label hasn't really affected what we want to do or what we want to try and achieve. It just gives more clarity.
Yes, similarly, it hasn't really affected our day-to-day research process. I think it would be fair to say that it is obviously something that we're going to be keeping eyes on, and we want to capture that information. But similarly, we do a lot of robust, underneath the bonnet, process-led, qualitative-led research. But I do think that there will be a challenge potentially for our industry or our side of the portfolio management if a fund aligns themselves or labels themselves in one context and our viewpoint is a different context. I think that is a challenge. How do you square that circle? So I think that's something that we're going to be keeping eyes on and be clear with, and we've been working with our fund managers to see. But I think ultimately what we're seeing a lot of fund managers move towards is that kind of fifth option of no label sustainable objectives. And I think a part of the industry will camp themselves there in the short term with the idea of going for a label further down the line once there's more clarity. But I still think that actually over the longer term, that will be quite a significant part of our market. So I would kind of, we always said that this won't be the be all and end all, but I think just generally for the marketplace, we shouldn't necessarily expect every fund that we would expect to see with a label have a label over the next 2 years. So therefore, you're going to have to still do that underlying research and do your own alignment work, if you like, on top of that.
Yeah, I tend to agree with that. I think we haven't adapted our processes around fund research, but maybe the conversation with fund managers has adapted a little bit to talk around their plans on SDR and the impact that that has on their portfolios, and then how that obviously would then feed into our multi-asset funds as well. But again, I think it's just quite difficult to plan because you don't know, you don't have the final guidance and things. But and it's also how you communicate that to clients, because if a lot of funds go for a sort of non-labeled option, but actually they're very strong on sustainability, it's communicating that and saying, that non-labeled doesn't necessarily mean that this is a fund that is weak on sustainability, and just making sure you're kind of tailoring those conversations so that the understanding is there around the different labels that are available.
Yeah, like the SFDR, if you use the SFDR as your standalone due diligence process in sustainability investing, you would have been probably quite harmed by the upgrades, downgrades, and all the bad feeling around that part of that particular piece of legislation. So with any piece of legislation, it's a nice to have, it's a nice bolt onto your process, but your process, in our view, can't change. Another reason for that is because the limited scope of SDR. We've already heard from Aegon about how ethical funds aren't fitting within the scope, which is, I personally believe, is a bit of a disappointment, and somewhere the FCA hopefully will come back on. But also a asset manager like Triodos, who the Dutch asset manager, who aren't within scope and probably won't be for maybe another year. So they shouldn't be penalised within your screening process just because they don't fall under the UK purview. For me, a lot of our clients, or some of our clients, are European. So I find myself using a lot of Luxembourg or Irish domiciled funds, which also fall out of scope. So it's a nice to have and something that would form part of the due diligence questionnaire, but definitely not the be all and end all, especially when it's evolving so rapidly as it is.
Cool. Thank you very much. Excellent timing as well. I'll come to you in a moment. I think what we're saying is the fact that Stuart haven't got their label probably won't result in a huge amount of outflows because it's still quite early. Question from the audience.
Travelling down the line, how long do you see us having to send out those 2 pages for every kid for every fund underneath within the MPS?
Did you hear that? No.
The 2-page summary. How long before the MPS has to have a 2-page summary for every single fund you have within the portfolio?
So he's just asking about how long will it be till we expect that we have to do 2-pager for every fund within an MPS. Dan, you want to take that?
Not sure. However, Q2 25 is looking like when we're going to start getting our guidance. We will then probably all come together. VirtueVest, for example, have a fantastic community where we all discuss these things as portfolio managers, try and pass the information, try and work out what's going on. So for me, I'm looking at Q2 25 and trying to plan as much as I can with the limited information I have until that point.
What Dan's referring to as well is that each of us is kind of a peer network. We have fed back to the FCA. As you can imagine, we have not told them that we want multiple pages to be sent out to clients because we do not think that is going to be very friendly. But I echo your sentiment in terms of what do we need to provide clients at what level, because it's just unsustainable sending that amount of pieces of paper. Anybody else want to comment on that question or related to the CFDs? All good. Yep.
Thanks. I have a question about KPIs, which kind of follows on from that fund research point. Have you started thinking about how you're going to apply KPIs? Our first kind of thought was, does the fund have an SDR label? Does it have an SFDR label? But then we get into the realm of non-UK domiciled funds, and suddenly it's all a bit of a, I don't know. So it'd be interesting to hear your views on KPIs.
this is, so we have a couple of offshore portfolios which obviously aren't in scope, but we're starting to think a little bit more about how it will apply when it eventually does come in. And I think one thing that's been very important for us is looking at the current makeup of the portfolio and looking at the current objectives, and then sort of using those to create the KPIs. So it all kind of goes hand in hand, and there's nothing that's being created from ground zero. It's kind of naturally coming out of what the process already involves. I think a difficulty for us is around in the MPS portfolios, the sustainable MPS portfolios, and I'm hoping the guidance will help with this, but where you have a cautious portfolio, you know, do we come up with a framework for government bonds so that we can actually have a label that isn't just non-labelled? And that's a big question mark for us at the moment in terms of KPIs and just general labelling, really. But yeah, that's kind of how we're trying to do it.
Yeah, I think from our perspective, this has probably been the hardest part of the puzzle to solve. And this is where, for us, particularly those extra layers of complexity come in over and above a single strategy, equity or bond fund. Because we're essentially trying to come up with a common framework set of KPIs that meet a wide range of geographies, asset classes, sectors. And we've had a project on this about identifying singular metrics, because the other big challenge, which I think we are facing, is that it's got to be an absolute measure. So relative measures are not suitable. And a lot of the data that we can get, which is broad enough to cover the universe, is got relative aspects to it. And for me, fundamentally, I think relativity is important, actually, in sustainability. You know, part of our ethos is about economic transition. It's about moving the economy and sectors on. So you need to think about an absolute and a relative context. But that's sort of been taken off the table. And when you actually look at individual KPIs, you know, whether it's emissions-based, waste and water. Firstly, you can see you get led down the environmental piece very quickly. Secondly, if once you can't just have one KPI. An emissions-based KPI for us would be a bit reductive. Once you add 2, 3, 4, trying to find enough investments which will tick a green box across all of those, it becomes almost impossible. So we're kind of going back to more of a basic viewpoint on what a KPI can be. And whether that ends up, we've got our own proprietary data systems, but they do tend to lean on relativity. So then does that take us out of scope of the label and into that, no label objective? So these are kind of the circular conversations that I think all of us are having as an industry. And the honest answer is I don't see the exact path that will allow us for a label whilst having KPIs in a multi-asset space.
Yeah, I think even in the single strat, let's say a multi-asset, so a mix, sustainable mix itself is a challenge, let alone when you start adding in risk profiles within that. And then, my question earlier to Sasha was about the prescriptive nature of it. It sounded like they are much more prescriptive than they initially told us. How is that going to apply for each of us when we have, additional complexities on top of it? And I think, Jade and Ben have actually explained that fairly well. And any other further comments from the panel? Do we have any other comments, questions from the team? Yeah.
Thank you. So just looking ahead to the next couple of months, if you're managing a portfolio on a discretionary basis and you decide to put a labelled fund into that portfolio, what type of discussions are you intending to have with the customer around that? Are you going to proactively talk them through the new 2-page consumer-facing disclosure or not? And just aware of that discretionary mandate, which means that you wouldn't typically, for example, provide the client with a KIID where you change a fund. So, thank you.
Yeah, thank you. It's a great question. Within our NPS at the moment, we'll have many funds within there that haven't got labels yet, and we will start to see labels being introduced within them. And as soon as that happens, we're ready and prepared to start issuing on all our key information documents, on all our brochures, be it online or hard copies, what exactly those labels are. And we'll work with our clients to explain why these particular funds have been chosen and what we expect going forward. How that might look, what the different labels might be, obviously we're still going through that process at the moment. So we suspect it will be a mixed bag of labels and perhaps some unlabeled funds in there as well. Now that's further down the line, how we are actually labelled in a year or so's time. But certainly we're prepared to show on all our literature what the labelling system within the funds we have are. And we want to be quite open and explicit about that. And it's just providing more information as well for you as a financial planner to help with your clients.
Can I just answer from what we're doing from our perspective, and then I'll come to you. I think your question's actually really interlinked with suitability as well, right? So how are you having those conversations with clients and what are you providing to them? So we've done a couple of things at Charles Stanley depending on the client type, because as you all know, you don't just have one client, you've got some that go into a product, some that have discretion. And with that, it's very much informing the investment managers or the financial advisors what tools they have in their kind of toolbook. At the moment, we don't really have much. There will be a sustainable fact sheet or a CFD. I much prefer sustainable fact sheet. I don't like talking about consumer-facing disclosure documents. Saying that to a client's absurd. But even those, we have all seen the templates of what they look like. They're not the most user-friendly. I'm hoping the asset managers make them more user-friendly. But really, that's the main tool that we're going to be using, as well as the explanation of the labels. But I do think this brings back to a piece of suitability that we haven't quite got right yet. That maybe over the next year, we're definitely talking about suitability and how we embed it with the new regime going on. Bit of a cop-out answer, but use what we kind of have and kind of see how those processes develop. Any other points on that before we go to this gentleman?
Just
sure.
a quick one, because something that I would really guard against an unintended consequence of this becoming is that a labelled fund should only be suitable for a client who has an express wish to invest with some sort of sustainable mandate. So, I really think, they can stand on their own 2 feet in any mandate. Now, obviously, once you get to certain thresholds, then you start getting into some regulatory suitability conundrums. But if it's 1 or 2 funds in a diversified portfolio and you are placing them in there on their merits because of the investment rationale, without wanting to give you guys any advice and with regulators all around me, I see that as very appropriate, and I think we got to guard against the idea of, oh, that's labelled, I've got to fit that through some sort of sustainable assessment with every single client.
Any other points on that one? No? Cool.
Earlier in the main programme, we were hearing how the international standards, ISSB, accredited accountancy standard was coming down the line. Is there any reason why waiting for that would be much more expensive for the MPSs? Is there some impetus for them to get on with it?
Anybody want that?
I was trying to hand this off as the question was coming in. I think it's a case of one thing at a time for us. We know that this is coming. This is going to be the requirement, and it's taking up quite a lot of our collective manpower in our businesses, or as groups, as VirtueVest and others, whilst we're also trying to manage the portfolios and conduct research and do all the other aspects. So I think, like most businesses, you have a sort of roadway ahead of you, and you just sort of address the thing that's coming down the pathway. So yes, we're aware that there's other ISB related things that might come in, but we'll wait to be told on that rather than having really the bandwidth, to be honest with you, right now to pre-plan on that front.
I think I'm the unique one that's really excited for it. So I am looking forward to ISSB because we have so many frameworks at the moment that will be pulled into it. What I'm not excited about is the wait and see nature, which we're also seeing with SDR. So, I've put together, it feels like I've put together multiple maps of what's coming up in future with a upcoming, unsure of date, not sure when. So can we do nothing in the interim? No, we can't. We have to do SDR, then we have to do extended SDR, and then we'll do TCFD again, and then we'll see where ISSB lands. But each of these things should feed into it, and the reason I'm excited is because they should just all pull together at the end. But we can't be sitting ducks in the meantime, and I know it's conversations we already have between ourselves, and definitely with the FCA as well. Any other questions from the audience? Excellent.
Thanks. It's a question for Ben. So I think what you said was that you mentioned what you might have to do if you disagreed with the label that a fund manager had used. So I was just going to ask you what you would do in that scenario.
Yeah, it's that's the good question. We haven't run up against this yet because obviously there's been so few funds labelled, but we have spoke about it internally. You know, if our viewpoint is it has this particular intentionality or focus behind it, then what do we do? And I think where this might, my initial thought of where this might come is more on the impact side, because we take a relatively, I suppose, firm stance, guarded stance on impact historically. And I thought there might be more funds that would actually be able to attain the threshold of impact, and we would probably actually maybe disagree on that. But actually, as it transpires, you know, the FCA have held a very high bar, and we've only seen, obviously, Webb in the room have done a fantastic job in that regard. So I think for us, it would be definitely dialogue with the manager. What is their viewpoint? How have they ended up in that? We'd obviously reassess our own research frameworks. Have we missed something? But ultimately, you know, I think we would lean on what do we view this fund's role in our portfolios. To Dan's point, these are useful insights, but they aren't the only thing we're going to look at of what the label is. If we still think that we believe it fits into our process or our portfolios and we can communicate why that is to advisors and clients, then we'll ultimately go down that road.
I think the other thing as well is, you know, I personally have been quite surprised about the Stewart situation, not being able to get a label. That does mean in some ways either I'm incredibly wrong as a fund selector and I don't know what I've been talking about for many a year, or perhaps the authorization process and the people at the FCA might be new to it. You know, you can pick whatever one of those. Happy to go with the I'm wrong piece. But broadly, we have investment processes in place that have been in place and evolved and improved over many years. None of us here, and maybe tell me if I'm wrong, none of us buy an Article 9 fund because it has an Article 9 label. So ultimately, our jobs are to pick the best funds and to put them in a portfolio. That's what we get paid for. That's our kind of, we're trying to build outcomes for clients there. So even from my perspective, yes, maybe if a fund gets a different label, I'd like to know why. But I wouldn't say, oh, well, it's got a different label. Oh, well then I shouldn't be investing it and taking that as gospel. Any more questions? Oh, Dan?
As we get to the end of the session, I just feel like there's an overarching point that does need to be made. And we talk about regulation coming down the line. There is a potential of over-regulation to the point where we can no longer deliver a diversified portfolio for clients that are in line with regulation, all the different types of regulation. And we're at a point where over the last 3 years we've seen fantastic innovation in sustainability-focused investing. Of course, there's been bad actors, and part of the FCA mandate was to get rid of those bad actors, and I do believe they've done that incredibly well. But the FCA regime, the document starts with the fact that 80% of people want to do good and make money. And you need to, the FCA from this point, when they talk about portfolio management, they need to facilitate a regime where we can deliver portfolio management across varied risk levels, but also do good and make a financial return, because clients aren't going to stick with it for the long term if we can't deliver returns that are suitable for their needs. So yeah, I just feel like that's a point that needs to be made, that we are getting very bogged down in regulation, but the point remains that we need to have that dual mandate for our clients. It's really important.
Good point, Dan, especially around the greenwashing versus green hushing. It's definitely something that we talk about quite a lot. And we are running up to time now. Is there... That's okay. We'll take one more from the audience. Yeah? Cool.
Thank you. Jade, you touched on this a bit earlier, but what are your views on kind of lower risk clients? From my point of view, if we stick with the 70% threshold, our kind of defensive clients are going to potentially be out of options because we've got about 40% in cash and government bonds. So I'd just be interested to hear your views on how you're dealing with lower risk clients who do want sustainable investment. And as you were saying, Dan, kind of matching the duality of the sustainable and the financial outcomes.
I think for low risk clients, again, we don't know exactly. Sorry. Because we don't have pure clarity on the guidance. I think at the moment the options that we're discussing is, do we create a framework that where we can sort of bucket the government bonds into a sustainability category in order to meet that 70%, and then go for a label within our cautious portfolios? or do we go for sort of a non-labeled, and then it becomes more around the discussion point with clients and actually.
Want to try that?
Is it this one? Sounds like I'm on a boat. Or does it become more about? Is it me?
It doesn't seem like you very much.
Okay. Okay. No, it's me. I don't know. Oh yeah, is that, sorry. Or does it become more around the discussion point? So if you don't go for a label within a cautious fund, or you don't label your cautious funds, it's just making sure that clients understand why. And it's not saying that you're still invested in a sustainable way, but your product doesn't have a sustainable label, and just really clearly outlining why that is. And it's just, once we have more information on the regulation, but also, just from your own internal processes, you can discuss how you integrate ESG into your fund selection process for the portion of the portfolio that is ESG integrated. So I think it's a communication or a framework or a little bit of both, I think, on that side.